Hello, and welcome to our Stepping Stones podcast, supporting Americans with each step of their unique journey in the UK. I'm your host for today, Trevor Egan, partner at Buzzacott, and I'm joined by...
I'm Chris McLemore. I'm a US lawyer and partner at McLemore Konchnik.
I'm Freddie Bjorn, partner at Payne Hicks Beach Law Firm in London.
And I'm Alex Porteous. I'm an associate director at Buzzacott.
In this episode, we'll discuss estate planning and inheritance tax. And to get started, let's share the story of our client Jason. Jason is a US citizen who moved to the UK from New York 5 years ago. He was previously married to Maria, but they have since divorced. He is now engaged to Tony, who is UK domiciled, and they are getting married in the summer. Jason is 51 and in good health. He has 3 children. He owns a UK property, has a US investment portfolio, and cash in UK banks. Jason wishes to pass his wealth on to his children, but is concerned about his worldwide exposure to estate and inheritance tax. So he's seeking specialist tax and legal advice. Step 1. The first thing that Jason needs to do is to plan now. Alex, what do you see as Jason's current tax exposure?
So Jason's got 2 sides. He's got the US side and the UK side. Starting with the UK side, he is not domiciled in the UK. He's not been here long enough yet for that to be a consideration for him. So by default, he's only taxable on his UK side as assets when it comes to inheritance tax. So that's basically 40% tax, in particular, on his UK property after the Nil Rate Band. The Nil Rate Band is sort of 2 components for that, £325,000 and then a further £175,000 because it's on a main property. So that's his UK exposure. On the US side, he's got around about $12 million lifetime exemption, assuming he's not made a lot of gifts during his lifetime. And it's only once he exceeds that threshold that he's going to have US tax to pay. And so then it comes down to the UK tax he pays, the US tax he pays, and the balance between the 2.
So straight away I'm seeing there's a massive difference between the UK lifetime allowance and the US allowance. Chris, could you expand upon the US side, please?
Yeah, I think that's a really important thing to note because the exemption is at a historical high. It's currently $12.06 million for the current year and is adjusted for inflation going forward. But it's scheduled to fall back to $5 million with an inflation adjustment on the 1st of January 2026. So it's not only is there a big tension between the Nil Rate Band amount of £325,000 that Alex mentioned, but there's also this tension between the $5 million that it will be in the future and $12 million now. So we're thinking about estate planning. Obviously we want these documents to last a very long time. We don't want anyone to be using the will anytime soon. So it not only has to contemplate the big exemption as it is now, but the potentially smaller exemption if there's not a congressional change in that number at some time in the future. I think the other thing to think about is, in these circumstances, it says that Jason is getting married to Tony, who's UK domiciled. They think that Tony's not an American.
That's right, yeah.
So normally when you have a US to US spouse, so transfers between spouses who are both US citizens, there's no estate tax, regardless of the value of the estate, should one of those individuals die. Where assets are going from a US person to a non-US person, yes, you get your exemption, either the $12 million or the $5 million, but everything above that is subject to an immediate tax charge. And I think we'll talk about later the disconnect that creates, but already Jason not only has, you could forgive him for thinking everything is fine, he's got $12 million to work with. It might be 5 soon, and he's got a non-US citizen spouse, so it's something to consider.
Thank you. And on that point, Freddie, any further immediate concerns for Jason on the UK side?
I think we need to look at domicile in a bit more detail. Potentially, Jason's in a really good position. He's only been here for 5 years, and as Alex mentioned earlier on, as potentially a non-domiciliary, he's only liable to inheritance tax on his UK-situated assets. There is planning he can do in advance of being here for a longer period to take advantage of that. Going back to the concept of domicile, whilst it appears clear that he is a non-domiciliary, he's a US person, etc., it is still important to go back to the fundamental question of domicile from a UK perspective, which is a unique concept. We initially, to establish domicile, look at an individual's father at the date they were born, assuming they were born in wedlock, which seems very old-fashioned, but that's the way it works. If they weren't, then you look at the mother's domicile. If he has what's called a domicile of origin in the UK, then we have other things to contend with. We're assuming here he doesn't.
Yep.
And if the answer is that he doesn't, which means he let's say has a domicile of origin in the US, then he's only going to be domiciled here if he remains here with the he's here with the intention to remain permanently or indefinitely, or from a tax perspective, he becomes deemed domiciled here, which means he's been here or resident here for 15 out of the past 20 tax years. Once he's here for 15 out of 20 tax years, he effectively becomes domicile for all tax purposes, albeit not for all purposes. And at that point, he's in a far worse position in terms of planning. And we're going to talk about that in a bit more detail. But for so long as he is non-dom and non-deemed dom, actually there's quite a lot he can do to take advantage of the fact that he's only liable to inheritance tax on his UK-situated assets.
Thank you, Freddie. And one potential curveball, if I may, his imminent marriage to a clear UK domiciliary,
Yep.
Could that change his intention? Could it have a bearing on domicile now?
It could. It would suggest that he's potentially going to stay here for a very long time. We often see it in practice that people will come here to become resident, and when you've only been here for 5 years, and unless you really do intend to remain here, it seems unlikely that his intention would be that long term. But it's obviously a trap. If you set up your life completely over here, then there's a risk that you actually become domiciled before you become deemed domiciled. And that is something which often gets glossed over because people always thinking about the 15 out of 20 year rule, which is not the only one to consider.
Thank you for that. Well, I guess he's been divorced once before, so who's to say he wouldn't get divorced again? So, yes, maybe
Let's
we're
hope
okay
so,
there.
yeah.
Yes, absolutely. Step 2, Jason's lifetime planning considerations. And remember, Jason's primary concern is to pass on his wealth to his children, eventually, I guess. Freddie?
We need to look at Jason's gifting based on two things, his UK-situated assets and his non-UK-situated assets. And the reason for that is, as we established earlier on, for the time being, it's only his UK-situated assets which are within the inheritance tax net. The other thing to bear in mind is that the UK doesn't have a gift tax as such, but we do have what's called a potentially exempt transfer, which is a gift which is made within 7 years of death, which is potentially taxable on death. The potentially exempt transfer rules don't apply to non-UK situated assets of a non-dom, but we've got to be careful here. Jason has a partner, Tony. They're not yet married, so any gifts between them will be outside of the spouse exemption regime. And therefore, not only do you have a potential 7-year tail, certainly on the UK-situated assets for Jason, but you also have the risk of what's called a gift of reservation of benefit, meaning effectively you've made a gift, but you've continued to benefit from that gift. And the effect is that it then doesn't fall outside of the inheritance tax regime and comes with all sorts of other problems. There's also capital gains tax implications of all this. And I think, Alex, you're going to run through some of these for us.
So on the UK side, essentially what you've got if you have a gift of a capital asset is a deemed disposal for UK capital gains tax purposes, essentially meaning that at that point, any gain on the value from cost basis to when it's actually gifted is subject to UK tax at that time. This can lead to a bit of a mismatch because those rules don't replicate on the US side. So you have a different situation with an asset being treated differently in both countries, which can get a little bit messy. I would like to elaborate a little bit about the potentially exempt transfer rules as well, because that's one of the places where it can actually work really nicely in your favour if you plan ahead. Because, as you said before, the US, you've got a big gap before you get to the US lifetime exemptions, whereas the UK, you get them much faster. But the US doesn't have this concept of potentially exempt transfer. So if you're making gifts of cash in particular to people in the UK, and you survive 7 years, that comes out of your estate, and that uses up some of your 12 million exemption in the US. So you can balance things out that way during lifetime to make gifts, get things out of your estate, down to the children early, and so mean that you don't have such a mismatch on death between the two tax brackets.
Can I jump in? Sorry.
No.
One thing I wanted to ask about was the CGT, because we're talking here in particular about his property. And in the UK, typically where you've got a main residence, you get 100% relief from capital gains tax on your main residence. My understanding is that in the US, you don't have an equivalent. So if he's looking at, for example, putting the property into joint names or similar, is there going to be a US issue to that?
Yeah, well, absolutely. So, as you say, in the UK, you get full capital gains tax relief. In the U.S., we have something similar in that when a U.S. person sells a property, including, by the way, a property located in the U.K. that has nothing to do with the U.S., if it's your matrimonial home or your family home and you've lived there for a certain period of time and you satisfy the rules, the first $250,000 of gain is exempt from tax, but everything above that is subject to U.S. U.S. income tax. So you can be in a situation where you sell a property in the U.K., there's no tax to pay here, but you've got a tax bill in the U.S., and of course, it's all magnified by changes in exchange rates, and other considerations. So it can be a nasty trap when we look at titling property in the name of a U.S. and a non-U.S. person.
Important to remember that there is no deemed disposal on if they gift the house to the children and he's no longer living in it. There's no U.S. tax on that point, but it does use some of the lifetime exemption.
But in that case, the children, and that's an important point though, because you've talked about the distinction between the U.S. and the U.K. In the U.K. or in the U.S., they would take his cost basis in that transfer. So the gift to the children would take his original basis, which means that they're potentially subject to U.S. tax. I believe they're U.S. citizens, which they are, when they ultimately sell it. So again, it highlights where those mismatches can arise between the U.S. and U.K.
And I think one of those mismatches, if just to lead on from that, is in the UK on death, if you're holding an asset, you get an automatic capital gains tax-free uplift on all of your assets. If you've actually made a gift during lifetime and passed on the base cost to your children, and then you have suffered an inheritance tax charge or a US estate tax charge because for whatever reason you haven't planned properly, you can end up paying inheritance tax and capital gains tax on the same asset, effectively on the same value or more in one of the jurisdictions. So it can be really unattractive if you get this wrong.
So we know that Jason wants to provide for his children, but primarily after he's gone. So solutions, please.
Well, if we were sat in New York rather than in London, and there were no foreign considerations here, we might be talking, depending on his level of wealth, about Jason settling a trust. So a lot of U.S. estate planning is driven by the use of trusts. And so it might be a good way for him to transfer assets into trust during his lifetime, either on a basis that he can take them back, but that helps from a probate avoidance and a planning perspective. But also, we've talked about that $12 million exemption potentially reducing to 7 or 5, so you're leaving 7 on the table. And so there is a consideration there about making a transfer to a trust for the benefit of his children, maybe his broader family, but doing it in a way that it captures and uses that exemption, that U.S. exemption, and then when he passes away, there's not a further charge to tax in the U.S. So again, this is just purely U.S. domestic planning. We'll layer on some of the U.K. considerations, but he might want to think about using a trust. It's a good way to make that onward transfer, but to retain some elements of control, particularly if the children are young or vulnerable, and also allowing him to potentially make changes to the document and provisions over time. That might be something that we'd be thinking about from a purely U.S. perspective.
And on the UK side, what you've got here is what's called an Excluded Property Trust, where you're getting it all set up before you become domiciled or deemed domiciled in the UK. And the idea mostly is putting non-UK cited assets into this trust, so it's all very much outside of the UK and therefore outside of the UK tax net from both an income tax, capital gains tax and inheritance tax perspective, as long as you kind of run it the right way and do all the advanced planning that you need to do. It's important to note you can put UK cited assets into that kind of arrangement, but those are always going to stay within the UK tax regime. So it's very much preferred that it's the non-UK assets that you're using for this to have this trust set up outside the UK for your children's future provision, with certain assumptions as to where everyone's going to end up in the fullness of time.
And also bearing in mind that if you do put UK situated assets into the trust, you're going to have an upfront 20% tax charge over and above the Nil Rate Band. Now, in some circumstances, that's actually attractive for whatever reason. People are willing to pay a lifetime tax charge for the protection, but it's a trap, and it's certainly something which you've got to bear in mind if it's the main home, for example, or any asset which you want to continue benefiting from, because then it becomes very tax inefficient and a nightmare for all of us here.
Well, I think, again, this highlights some of these distinctions. So I said if we were in New York, which we're not, we'd be talking about trust. But then when we layer on the UK considerations, we haven't even talked about income tax for the beneficiaries if they're U.S. citizens resident in the UK and the issues you might have there. But already, that $12 million exemption is really enticing, and we think, let's use it, let's make a transfer into trust. but by the way, you can't contribute your home, you can't contribute your UK situated property. Any transfer in is going to trigger capital gains tax, and suddenly we see some of the potential pitfalls. Those are manageable, and it might be that he's got sufficient wealth, that's liquid in the U.S. that can go into this trust. It can be brilliant planning. He's got children from a previous marriage, so a trust might have, appeals from, a family perspective, but there are a lot of potential pitfalls in that path.
And then leading on from there, I suppose, is thinking about the trust itself. Who are going to be the trustees? Where are they resident? Those kinds of questions, which in the UK we might be quite comfortable with having UK resident trustees, or it might not be particularly tax efficient from an income and capital gains tax perspective. But in the US you might feel, no, we can't have UK resident trustees of this trust because that creates an absolute headache for us. And that leads to the sort of next step of the planning when you're doing an excluded property trust, is actually thinking through not just what are the initial tax implications, but what are the longer term tax implications? You touched on things like, how do the beneficiaries get taxed? And I often think when you're planning with people, it's very easy to put forward an excluded property trust as a great way of protecting the inheritance tax. But at the same time, you're potentially building up a pot of potentially taxable assets, which when the next generation inherit, if they're going to inherit outright, they get a huge tax charge with it, albeit not an inheritance tax one. So you definitely have to look at the circumstances of each individual before you go ahead and put these things in place.
And to some extent, you've got to try and predict the future, which is where the beneficiary is going to end up. If you're very comfortable that the whole family is going to decant back to the US in a few years, you take one approach. If there's a chance that some of the beneficiaries may still be in the UK, then you want to try and build in some flexibility at the outset. And any kind of flexibility can be arranged, does come at a tax cost. But it's trying to say, okay, what are we trying to do here? Are we trying to save income tax? Are we trying to save capital gains tax? Or are we trying to save inheritance tax, or everything? If it's everything, then you've got to very specifically say, this is what is going to happen. And mostly that means people are not going to be in the UK when they receive the distributions. Otherwise, you can arrange it so you've still got that inheritance tax saving, but the income tax and capital gains tax is perhaps lost along the way as the sacrifice for the flexibility.
I think, though, that we've been quite good at raising some of the pitfalls. I think that an excluded property trust, though, can be really compelling for a person in the situation, especially as the wealth number gets bigger, and especially as a prevention against falling into the UK inheritance tax net. And what we don't know is, and we've talked about, we don't know how long Jason's going to be here, and he might not know. But if he's going to be here a modest period of time beyond his deemed domicile date, it might be quite compelling to put everything in a simple trust, fairly simple trust, that works to prevent those assets falling into the inheritance tax net, but that he'll have control and can take back. It's not a completed gift in the future if he does return to the U.S. So I think there really is a compelling, option here, but this is where the actual facts kind of would dictate where we go.
I agree with you totally. And in a situation like this, there is no question it would be something you put on the table and look at for Jason. You also just need to bear in mind that we've got 15 years until you become deemed domiciled at the moment. That's already gone down from 17. There's a good chance that it will get shorter and shorter. You don't want to miss the window of opportunity.
And I think one other thing we might think about here, because an excluded property trust or trust planning is not the only option. He's got 10 years until he's deemed domiciled. So that's a significant period of time. So it might be a bit premature to start chucking assets into a trust to prevent the application of inheritance tax this far, although it's good to have on the radar. I think the other thing to think about is life insurance. Is there a place for life insurance? Again, if we're just thinking about beyond the normal benefits of life insurance, okay, if he's going to be here 5 years past the deemed domicile date, he thinks maybe that's when his contract expires. He's going to sell his country. The kids go on to secondary education or what have you. We might just protect against the inheritance tax mismatch with the U.S. exemption by taking out some life insurance, and we could talk about how to do that. But that might be something else to consider.
So in summary, Jason has plenty to think about.
We've talked a lot about Jason, but what about Tony? I'm conscious that Tony may also have considerable wealth, and that wealth may be tied up both in the UK and in the US. And as we've already discussed, the fact that Tony is UK resident and UK domiciled will mean that Tony's actually got an exposure to worldwide inheritance tax for UK purposes. So what exposure might there be in the US for Tony on the US Citus investments?
Let's assume on these facts that Tony and Jason met whilst in the U.S. Tony might have investments over there. For somebody who's not a citizen of the U.S., we go back to this concept of domicile, which was talked about earlier. And the U.S. concept of domicile is very similar to the U.K. one. Tony is probably not going to have a domicile in the United States. So Tony is going to be subject to U.S. federal estate tax only to the extent of U.S. situate property. So I think you used the example of Apple shares. So let's say somebody's invested in a whole load of Apple shares, but they're not a U.S. citizen, regardless of where they live, and they're not a U.S. domiciliary. They're going to have exposure to U.S. federal estate tax, but the exemption is not $12 million, not $5 million. It's $60,000 US. So immediately, if you have any investments in the U.S., you're into a potential U.S. estate tax charge. So think about you, Freddie. You're here in the U.K. You're not a U.S. person. You're not a U.S. domiciliary. If you bought a load of Apple shares, you'd have immediate U.S. estate tax exposure. However, being sat here in the U.K., we could then rely on the U.S.-UK estate and gift tax treaty. And that would say that the U.S. wouldn't be able to tax those assets, the Apple shares in this case. Only the UK could. But that requires the application of the treaty, and it requires that somebody lives in a treaty jurisdiction. So if they left the UK, for instance, there could be exposure. The other thing to think about is, what if Tony bought an investment property or had a home while in the United States? Real property is different. So we've said that the treaty would prevent the U.S. from levying federal estate tax on the shares, but piece of real property works differently under the treaty. So there might be U.S. estate tax consideration there, which of course would need to be accounted for in the will planning.
And depending on what state that property is in, there could also be state estate tax considerations.
Yeah, and to make it even more complicated, there are states with estate tax, there are states with inheritance tax, there are states with both estate tax and inheritance tax, and states with neither. So you're right, and the treaty may not affect any of that because it's a federal treaty. So the considerations, I think, go perhaps beyond the scope of this, but we would need to think about, yes, we've been talking about Jason because he's a U.S. person. What does Tony have? Is Tony exposed in the U.S., and how do we deal with that?
And I think from a UK perspective, or from a planning perspective more generally, what we're always trying to do is to avoid a double tax charge at different times. And you often have this when you're dealing with US-UK matters, is people are saying, well, I don't really want to pay any tax in the UK or the US. And you're saying, well, our job obviously will help you do what you can to minimize your tax, but actually our job is to avoid a double tax charge. And what you can have is situations where you end up, for example, with one party paying 40% on their death, but the same thing being taxed on the other party at 40% further down the line. And that double tax charge obviously wipes out most of the inheritance for the next generation. And so I suppose that's why it's key to make sure that we don't end up with these two tax charges, one in the UK just because someone is domiciled here, and one in the US because the assets are cited there.
Indeed, be it estate tax, be it income tax, be it whatever. Invariably, I'm always saying to my client, the key is that you pay the right tax to the right jurisdiction at the right time. That's where you then minimise the double tax exposure hit. So to summarise for Jason, the benefits of taking advice are that he will get the comprehensive answer on the US side, on the UK side, the legal advice, the tax planning advice, wills, making sure that his objectives are satisfied, inheritances to his children, looking after Tony during lifetime, whatever it may be. So clearly, absolutely vital that he gets this right, and he does it now. Moving on to step 3, the importance of a current and a valid will. This is the question I get asked all the time by my clients. Do I need a US will? Do I need a UK will? Do I need both? Your thoughts, please.
Yeah, I think, sometimes, especially, in our role, we think about the tax before we think about anything else on a will, or we can get kind of carried away with it. There are really two elements to will planning. There is the tax side, which we've talked to here, and it's kind of driven the conversation, but also the non-tax side. And this is what people think about when they think about will planning. Their mind doesn't go to tax. It's, who do I name as my executors, and how do I get that done? If there's a trust in the will, and in these facts there certainly would be, Who are the trustees, potentially protectors, also in that document? Who are the guardians of my minor children, if I have them, if the two spouses, the two parents pass away?
And will the guardianship clause be reflected in, if we only got one will and it's under UK law, let's say, does the US recognise the guardianship provision in the UK will, especially if the guardians are back in the US, but your life is over in the UK? Will the US accept what's set out in the UK will with bringing the children over to the US?
And I think that's right, and that highlights this question about that you've just raised. And clients will ask the same of me: do I need a U.S. will? Do I need a UK will? Do I need one will? Again, that's very much driven by what they're trying to achieve and their facts. I think the takeaway, though, is that it can be any of those, right? And it can be one document. In many cases, you have one document because the U.S. and the U.K. have very similar laws when it comes to probate, although not identical. You can have one document that covers your assets in the UK, and then we trot that across the ocean to the US and do probate there. Of course, it's going to depend on where you've got assets in the US, which state, because we've got 50 different potential jurisdictions for probate. So the answer is yes, you can definitely achieve, on these circumstances, what he wants to achieve with one will, but it will depend. And there are certainly cases where, restricting the U.S. assets, for instance, to a U.S. will, the U.K. assets to a U.K. will, might be more appropriate.
And it potentially eases probate. You're absolutely right. The rules are very relatively similar, so you would be able to use the same will, but also, as you mentioned, you have to probate it on one side of the ocean before it gets done on the other side. The administration of an estate is certainly getting the grant of probate. So at the moment, it can take 6-9 months, sometimes a year, to get to the grant of probate stage, which means that during that time you've effectively got frozen assets in one jurisdiction while you wait for the other jurisdiction to effectively catch up. So, as you say, it's worth thinking about, especially if you've got material assets in both jurisdictions.
Sometimes what you'll have is maybe just, I think in these facts, he's got financial accounts in the U.S. So in that case, you might think it's not as necessary, but you're exactly right. Having contemporaneously running probates can be really valuable, especially if there is not much liquidity in the estate, right? So when can we start getting assets out? How important is that? What other assets were in the estate, or did the surviving spouse have? So all those considerations will matter.
I mean, one thing I would say here is Jason's not yet married. From a UK perspective, what is absolutely key is that marriage automatically revokes a will. There are plenty of people who have entered into wills many years ago, got married and never updated them. They are intestate from a UK perspective, which is an absolute nightmare. You can enter into a will which is in contemplation of a marriage, and to do that you would actually have to specify on the face of the will that you are contemplating marrying a particular person. You can't just have every will, one day I think I'm going to get married. It doesn't quite work like that. So it's key that Jason has taken that into account. And I think one of the things that Chris mentioned earlier on is that when you're approaching wills, you approach them from one of two directions. You deal with the tax side and you deal with the devolution side, how you actually want your assets to pass. From a UK tax perspective, we've talked about the fact that Jason's UK situated assets are within the UK inheritance tax net. So when I'm looking at a scenario such as this, almost regardless of whether or not he gets married, I would want to make sure that his non-UK situated assets, which are outside of the UK inheritance tax net, are passed into some form of trust, which doesn't get dragged back in on his death. But I know that the rules are slightly different over in the US, so Chris can enlighten us on those.
Well, I think, a trust, I think, would be very helpful on these facts. Again, there's lots of reasons for that. Even on more basic facts, I think we'd be looking at having a trust involved. But we talked about it earlier. The key consideration here is that his future spouse is not a U.S. citizen. And so that means, whereas in the U.K., or if your assets are going from a U.S. spouse to a U.S. spouse, you get the full exemption, so there's no tax at that point, which is great because the spouse, gets the full benefit of the estate, doesn't have to come up with any, tax bill. When it goes to a non-citizen, there's an immediate charge. Again, you still have your $12 million exemption, so if you're under the $12 million, that consideration is less crucial, but of course, the exemption is coming down to $5 million. So the only way to get around this potential tax charge is by using a special type of U.S. trust. called a QDOT, which is a qualified domestic trust. Basically, it's just a trust for the benefit of the surviving spouse with some additional restrictions built in. But by putting the assets into a QDOT, the assets that are over the exemption, it prevents them from being subject to tax. So we can imagine a scenario in which his estate, let's call it, is $20 million, when he passes away. We've already said everything that's subject to tax in the UK would go free of tax to the spouse. The US would say, okay, the first 12 or the first 5 is free of tax, but everything over that, so in my example, $8 million, is subject to an immediate US tax charge. And not only is that problematic because the estate or the surviving spouse has to write a check to the IRS, and nobody's going to be happy about that, but also those assets are then going to be subject to UK inheritance tax in her hands when she later dies. And so not only do we have the immediate upfront U.S. tax charge, we also have a pure double tax charge on that portion that passes to her. And so, the QDOT can be a really powerful tool. It's not without its frustrations, but at least putting a language in the will that allows the executors to look at the circumstances at the time, look at where the exemptions are, look at the value of the estate, look at the potential tax liability, and then consider making an election to have assets in the trust subject to the QDOT rules is incredibly important.
And it's worth saying that the QDOT works actually very well from a UK perspective where you're trying to get the UK spouse exemption, because we have what's called an immediate post-death interest trust in a will, which ensures that where the person with that immediate interest is the surviving spouse, that you get spouse exemption. The only exception to that is the flip side of what you have in the US, whereby in this case, if Jason and Tony marry, because Tony is domiciled in the UK and Jason is not, there is a restriction on spouse exemption on assets passing from Tony to Jason. And it's the flip of the public policy reason why you have it in the US. Namely, if Tony was very wealthy and could leave everything to Jason tax-free, getting spouse exemption, and Jason's non-dom, effectively everything then's been shifted offshore, and the HMRC never get their inheritance tax. Because I guess marital deduction's the same, but spouse exemption is only a deferral. It's not an actual exemption from tax.
And what practical advice would you give to Jason in terms of his wills and just making them and keeping documentation, etc.? I mean, I'm interested to hear that, please.
So we spent a lot of time talking about wills, and those are very important documents. What we haven't mentioned are lasting powers of attorney or powers of attorney in the U.S. This is something that very often is part and parcel of an estate plan. Broadly speaking, your U.S. power of attorney is not going to be effective in the U.K. Your U.K. powers of attorney aren't effective in the U.S. So make sure that you consider those as part of this process. You might already have them. It's just a really great time to kick the tires on those documents. Also, updating potentially the beneficiaries of your life insurance or your pensions. In this case, there's been clearly a transition in Jason's life. If he gets married to Tony, or even if he doesn't, he might want to name Tony as the beneficiary of life insurance to the extent it's not owned in a trust, update his pensions. They might be, for instance, with his former spouse. He might want to bring his children into that mix. So those things are things to think about. Again, and at the creation of your will is a really important time because you don't pick these documents up very frequently. So it's a good time to look at the other things that are kind of in that broader orbit of what we would consider estate planning.
And I echo that completely. The position is exactly the same in the UK. You want to make sure that documentation is revised every few years to make sure it reflects what your current position is, especially if you've got young children. The difference between children 5, 10, 15 and the sort of 20 is quite different. And it's amazing how often people revise their wills and their letters of wishes and so on when kids reach later in their teens. Having merrily said they could have everything at 21, they often change their mind quite rapidly when they see their 19-year-old shortly inheriting significant sums.
Well, and you've just mentioned something that we haven't mentioned is letter of wishes. So again, the will is a very important document, but it's really quite mechanical, and it contains a lot of tax provisions and trust provisions and provisions for the executors, the lawyers, the accountants. And the letter of wishes sits alongside it, a non-legally binding document that breathes life into this very almost formulaic will. And it's not only important because, God forbid something happens to you, you pass away, your executors might be left with a huge estate and children to look after who might be quite young. They have a lot of decisions on their plate. What would you, as the decedent, want to have been, to happen. A lot of considerations to be done there. But also, it's not legally binding document, so it can be updated without the same formality as a will. So the will, again, is quite structured and is there in place. As your children get a few years older, you don't have to update the will, but you might wish to update the letter of wishes. If one of your children makes you angry, they do something you don't want to that you don't support, they become Tottenham Spurs fans, for instance. You could cut them out of your will in a letter of wishes. So that's something that we would definitely, that's something you can kick the tires on more frequently than you would a will, but is a document that oftentimes gets overlooked by the clients.
And you mentioned cutting people out, which actually is quite permissible. In the UK, we have what's called testamentary freedom. You can generally just leave your estate to whoever you like. But I'm conscious in the US, the different states have different rules on succession.
Well, and yes, they do. We have testamentary freedom in the US as well, but you can't cut out your spouse, for instance, in the UK. So there are some restrictions on that. Again, in these circumstances, that's not going to be contemplated. But certainly you could use a letter of wishes to make changes with respect to your family.
Alex, I think you were going to conclude on some other personal tax bits which we should be thinking about.
Yeah, so I think, first of all, there's the bits just kind of follow on exactly from what you guys are discussing, which is just broadly sharing your plans. Where is your will? So if something happens to you, your executor, well, who is your executor? Do they know they're your executor? Do your kids know where everything is? And even just general life admin, you have 1,000,001 different accounts all over the place. Where is that information? Because there could well be things within those bank accounts, but also just other forms of accounts where they would not have access to it. And so making sure that information is available and is saved somewhere sensible that can be located. And then on the more sort of personal income tax side, it's just making sure you're up to date. It can be very easy to fall behind. 1 year goes by, another year goes by. You're like, oh no, that's all right. I'll catch up with that. I'll get it done, and then you get hit by a bus, and suddenly this is a problem for your executor, for your children. Is working out what happened several years ago. Employment income, all kinds of things that it would be very difficult for them to piece together. So leaving that kind of problem for them, it would create a real issue on top of the general issues they're going to have following your decease. So making sure you're up to date is absolutely key, so you're not leaving any kind of personal tax problems onto your inheritors.
So clearly, we are all in agreement of the vital importance of taking competent, comprehensive, joined-up tax and legal advice.
Yeah, so this is actually a question that gets that clients have. Where do they go first? In these facts, in this circumstance we've identified, Jason's not going to get out of this without a document that's reviewed by a U.S. lawyer like myself and a UK lawyer or a solicitor like you, Freddie. So where do they start? I think the message is it doesn't matter where you start. So certainly as a U.S. lawyer, and law firm McLemore-Konchnick is only U.S. lawyers, despite the fact that we're based here in London. We would never do an estate plan for someone with facts like these or any type of UK elements involved without involving someone like you, involving a solicitor, and having you on board. So at the end of the day, it doesn't matter where you start. You can end up with both of us, I think, is the takeaway. And I think you see that as well. Clients perhaps starting with you as a UK resident, somebody here in the UK, but presumably needing US advice.
Yeah, and I think it depends where the client has come in from, who's actually suggested that that we're contacted. I often think it's best to get everyone involved at the outset. Just as you said, at Payne Hicks Beach, we can only do the UK side of things. I think we do it very well, but we can't do the US side. So from the very outset, especially with a complicated situation like Jason's, I want to make sure I had the accountants involved. I want to make sure I've got the US lawyers involved. And I want to make sure we know all the facts before we start advising, because it can become very costly for a client if you do things piecemeal. And often clients are thinking it's a good way of saving money by doing things piecemeal, because I won't bother going to the accountants yet because we might not need them, or we might not need the US input on the legal side. And actually, it rarely is the case that that's beneficial. Generally, if you all come at it from the same direction, it's much quicker, much more effective, and I think the outcome from the client's best.
And I think it's worth saying, so Buzzacott, we're what are called dual handlers. We're US, UK tax specialists. So we kind of, we blend to some extent both parts of what you guys do, but from the tax side. And so we're looking after clients on an annual basis, looking after the tax returns, seeing how their lives change over time. which means, for example, if the client, they get married, at which point we're like, oh, right, now you've really got to look at your estate planning again. I'd like to introduce you to some lawyers and solicitors that we know who can really help covering both the US and UK side. So we're seeing the life of the clients, and then it's making sure that we can help them plan for what happens in the future.
Well, thanks to our speakers for joining us today, and thank you to our listeners for tuning in. Plan your next steps by looking at the other podcasts in this series, covering topics such as business, property, investments, and more. Thank you.
Thank you.
Thank you.
Thank you.